Hello everyone, Brittany Elliott here, and today we are going to talk about traditional IRAs and Roth IRAs. We are going to go over what traditional IRAs and Roth IRAs are, why they're beneficial, and most importantly, how you can make them work for you. But before we get started, remember, hit the subscribe button and the bell icon to turn on notifications so that you don't miss out on future videos. Okay, now let's get started. So what are traditional IRAs and Roth IRAs? These are two different types of individual retirement accounts, hence the term IRA, that are opened and owned by an individual and not through your employer. Now, in order to contribute to either of these types of accounts, you will have to have earned income equal to or greater than the amount that you contribute. Earned income is taxable compensation. So this would be wages, salaries, bonuses, tips, commissions, and also net income from self-employment. This does not include other types of income, such as pensions, annuities, Social Security, or income that's passive from other types of investments. So if those are the only types of income you have, you are not eligible to contribute to either a traditional IRA or a Roth IRA. Now, there is an exception to this rule, and that is what's referred to as a spousal IRA. So if two spouses, one works and one has little or no income, the spouse that has income is eligible to contribute to an IRA in the name of their spouse that otherwise would not be eligible to make contributions. So, for example, there's a husband and wife. Husband works, wife stays home and takes care of the children in the house. So the wife does not have any earned income to qualify for an IRA, but the husband does have the income. So they file their tax return jointly. Husband can put money into his IRA, and he can also put money into an IRA for his wife. Okay, so how much can you contribute? The IRS sets maximum contribution limits each year for these types of accounts. Sometimes that limit will stay the same for several years in a row, and then it'll have an increase. Other times it can increase a little bit each year for a few years. So be sure to always check for the current limits before you make a contribution. You can do this with IRS at irs.gov, or you can do a quick Google search, or you can also consult your tax professional. Now, for tax year 2023, the contribution limits are $6,500 if you are under age 50 and $7,500 if you are age 50 or over. Again, that's assuming you still have earned income equal to or exceeding those limits. Now, both traditional IRAs and Roth IRAs can be beneficial, but it's very important for you to understand their differences so that you can choose which account makes the most sense for your situation. Also important to note here is that the type of IRA that is right for you may change over the course of your life. So what's beneficial to you today, in a few years, the opposite might be beneficial to you. So it's important to look at the considerations each year before you make a contribution. You may very well end up with both types of IRAs. First, let's look at traditional IRAs. With a traditional IRA, the money you contribute to the account is tax deductible as long as your modified adjusted gross income for the year is below a certain threshold. These thresholds change from year to year, so I'm not going to list them here, but you can always find it on the IRS's website at irs.gov or through your tax professional or even a Google search. Now, if your income falls above these threshold limits, you can still make contributions to the account. They just won't be able to be deducted on your tax return. So these would be what are referred to as non-deductible contributions or after-tax contributions. An exception to this rule is if your employer does not offer an employer-sponsored retirement plan, such as a 401k, 403b, or simple IRA. If that is the case, then regardless if your income is too high, you can still take the full deduction for the contribution to your traditional IRA since you do not have access to an employer-sponsored plan. But regardless of whether or not you're eligible to take a deduction for the contribution, the money inside the traditional IRA will grow tax deferred, meaning you will not pay taxes on it each year as it grows. You will not pay taxes until you withdraw the funds from the account in the future. And then once you do begin making withdrawals, you will only pay taxes on the amount that you withdraw from the account. So the remaining balance that stays in the account will continue to grow tax deferred until you actually withdraw it from the account. Now, if your traditional IRA happens to include any non-deductible contributions or post-tax contributions, as we discussed earlier, then a portion of each withdrawal you make from the account will not be taxable, since a portion of your IRA balance contains after-tax dollars. Now let's talk about withdrawals. So once you reach age 59 and a half, you can withdraw from the IRA at any time without penalty. You will just be subject to income taxes on the amount withdrawn. Now, once you reach a certain age, which is currently 73, but it's going to increase to age 75 in 2033. So once you reach this age, you have to begin taking what are called required minimum distributions from your traditional IRA accounts. Now, this is where the government sets a minimum percentage must be withdrawn from the account every year, beginning at this age, whether you need the funds or not. This is calculated based on your age and the account balance at the end of the previous year. So your custodian will be able to show you and tell you, you'll be able to log into your account and you'll be able to see this is what my required distribution is for the year. If you don't see that readily accessible, call your broker or call your tax professional just to make sure that you know exactly how much you have to take out of the account. It's very important to take your full required distribution. This is because there's very stiff penalties for failing to do so. It used to be way worse than it is now. It used to be that 50% of the amount that you were supposed to withdraw was a penalty, and then you still had to pay taxes on the amount withdrawn. So if you have a really large balance and your required distribution is $100,000, you would have a $50,000 penalty for failing to take your required distribution. Now, in 2023, thankfully that has been reduced, but it is still a whopping 25% penalty plus the income taxes. So again, it's very important, remember to take your RMD, because otherwise you will just be wasting a ton of money on penalties. Now, there's a lot more complicated details we could get into on required minimum distributions, but I'm going to save that for a separate video because that only applies to a small portion of you that are watching this one. So if you're interested in learning about that, be sure to watch for that video coming out. Now let's look at Roth IRAs. With a Roth IRA, the contributions that you make to the account are not tax deductible. When you file your taxes each year, you will report that you made a Roth contribution in any year that applies, but you will not receive any tax break for making the contribution. Remember, just like with traditional IRAs, you will need to have earned income or be eligible for a spousal IRA contribution in order to contribute to the Roth IRA. Also, your modified adjusted gross income must be below certain threshold amounts in order to be eligible to contribute to a Roth IRA. So again, as I mentioned before, these amounts change every year, so I'm not going to bother listing them out here. Just you can go to irs.gov or do a quick Google search or consult your tax professional to say, what are the income thresholds for making Roth IRA contributions in whichever tax year you're looking at it for. Now, like with traditional IRAs, the money inside the Roth IRA will grow tax deferred, meaning you will not pay taxes on it year after year. As the balance grows, it will not be subject to taxes. Also, once you begin making withdrawals, the remaining balance in the account will continue to grow tax deferred. Now, the major benefit of a Roth IRA is that once you reach age 59 and a half and you've held the account for at least 5 years, any of the qualified withdrawals you make from the account will be completely tax-free. This means that all of the earnings in the account, everything in that account above your contribution amounts is completely tax-free money. Now, if you make withdrawals from the account before age 59 and a half, you will be subject to a 10% penalty on the earnings withdrawn from the account. Note I said the earnings, so any amount above the amounts that you have contributed to the account. You can, however, withdraw up to your contribution amounts at any time from the Roth IRA without any penalty and without taxes, since it's money that's already after tax. While that might sound great, and it can be a very useful tool in certain situations, I strongly, strongly recommend against withdrawing from your Roth IRA until you have reached retirement and actually need the funds for retirement. The reason being here is, remember, the money in this account is growing tax deferred, and if you wait until you are qualified to do so, your withdrawals, it's all tax-free money on all of that growth. So if you take a withdrawal from the account earlier, say when you're still in your working years, if you take a withdrawal from that account, you have forever reduced the amount of money that you can have growing tax-free. Now, if you withdraw money and you put it back in within 60 days as a rollover contribution, you can get the funds back into the account, but that has to be within a 60-day window, and you can only do that once every 12 months. So if you go past there, you're never going to be able to get that balance back up. If you're still working and you're still having earned income, then you can still continue to make new contributions to the account, but you'll still be limited to the maximum annual contribution limits. So again, you will forever reduce the balance that you can have that is compounding and growing tax-free. So I'm going to sound like a broken record here, and that's for a reason. Just please do not withdraw from your Roth IRA until retirement unless you have no other viable option. Now, there are a few situations where you can withdraw from the Roth IRA early and not be subject to a penalty, but you would still have to pay taxes, such as for a first-time home purchase, and there's a few other things. But again, I still would just strongly recommend against withdrawing from your Roth IRA unless you absolutely have to. Now, unlike traditional IRAs, Roth IRAs are not subject to RMDs. This means that you will not be forced to withdraw a certain portion of the account at a certain age. You can leave the money in as long as you want to. At least that is the current rule. Obviously, legislation can change over time, year after year. So that is just the current situation, but keep that in mind that, Congress could pass a law that would change that in the future. So now that we've covered a lot of details on traditional IRAs and Roth IRAs, you may be wondering which of these accounts is best for you. Well, the answer is that depends. And it depends a lot on what your current income level is, what your current tax bracket is, and what you expect your income and your tax bracket to be in retirement. Remember, your retirement income will include your retirement account withdrawals, pensions, annuities, Social Security, and any other investment income you may have. So you may think, well, I'm going to make a lot less money when I retire, or I'm going to have a lot higher income when I retire because I'm saving a lot of money. And so I'm going to be making a lot of withdrawals. But again, it all depends. Is this in a tax-free account or a tax-deferred account? There's a lot of factors to consider there. But that being said, generally speaking, the Roth IRA is almost always going to be the better choice. There are some rare circumstances where it's not. So I'm not telling you which one is right for you. But generally speaking, the Roth makes more sense simply because you get all of that growth completely tax-free. Now, I'm sure there's quite a few of you out there who are thinking, wonderful, I would love to have a Roth IRA. I want that tax-free growth, but I make too much money. So if your income is too high to qualify you to make a direct Roth IRA contribution, don't worry, there are other ways to get money into a Roth IRA, but I will cover those in separate videos. One way is through a backdoor Roth IRA contribution, and another is through doing conversions where you convert money from your traditional IRA to your Roth IRA. But again, those will be separate videos, so just look for those to come out soon and get that information. Okay, one more detail I want to make sure to include here is that the contribution limits that are set each year, that is a collective total contribution limit. So if you have a traditional IRA and a Roth IRA, between the two accounts, you cannot contribute more than that contribution limit, which for 2023 is $6,500 if you're under age 50, $7,500 if you're age 50 or over. So even if you wanted to open up, say, well, I want 3 different Roth IRA accounts, that's almost never a good idea. There can be reasons why somebody might want to have more than one of that type of account, so that can apply, but it just simple is almost always better. So one account, cut and dry, don't have to worry about tracking so many things. But if you had more than one Roth IRA or more than one traditional IRA, it doesn't mean you can put $6,500 into each. It's your total between all of your traditional IRAs, all of your Roth IRAs cannot exceed the annual contribution limit. All right, there you have it, the differences between traditional IRAs and Roth IRAs. Remember, contribution limits, income thresholds, as well as other rules around these types of accounts can change over time. So be sure to consult the IRS's website or your tax professional prior to making any contributions, just to make sure that you know the whole picture and make the most informed decision for you. Well, everyone, I hope that you learned something today and this has been helpful to you. If you have any questions or comments, please leave them below in the comment section. I'd be happy to answer them. Also, please remember to click the like button, as that will help this video reach more people. And also remember to subscribe to my channel so you can catch future videos as they come out. Thank you all and have a wonderful day.